With the JobKeeper scheme, the Jobseeker bonus, the home builder scheme, and the bank repayment holidays all coming to an end in the coming weeks, what will this mean for the Australian economy and the Australian housing market? With so many Australians relying on these programs, it could suggest that we're about to see some hardship in Australian families. Despite the Australian housing market seeing one of the greatest booms in history, and the median house price in Australia reaching a record high, could the combination of so many negative factors bring the property market crashing down? And are we about to witness one of the greatest property crashes in our lifetime? Hey guys, welcome back to the channel. In today's video, we are going to once again take a deep dive into the Australian housing market. If you guys have been watching my previous videos, you will know that I am very bullish on property. But to be fair to everyone watching this video, I want to enter this analysis without any biases and an open mind. I'm not going to try to convince you that the Australian dream is alive and well, nor am I going to try to prophesize a doomsday crash of the Australian property market, but instead present to you the arguments from both sides so you can make up your own mind on what you think will happen in the coming years. To do this, we are going to look at some data, some historical trends, and some macroeconomic factors which all play a very important role on the future of the Australian housing market. This video is going to be packed full of useful information and content, so make sure you watch it till the very end so you don't miss anything. Just a quick disclaimer before I start, I am not a financial advisor, nor is this financial advice. I'm simply some guy sharing his personal opinions and views on certain topics. You should always do your own research and due diligence, and I will strongly encourage you to seek the help of real financial experts before jumping into any big financial or investment decisions. And without further ado, let's get straight into the video. Let's start by discussing how hot the Australian property market is. Only 2 months into 2021, the Australian median house price has already reached a record high after surpassing the previous high set in 2017. This was largely due to the very strong and honestly quite insane growth seen in all capital cities in the last few months, combined with double-digit annual growth seen in many regional markets. To most people, this really doesn't make any sense. We are coming out of one of the worst economic shocks in our time, and so many businesses have closed their doors for good, and so many people have lost their jobs. And with income and wage growth at such low levels, why are we seeing this explosive growth in the property markets? Well, I'll be lying if I told you I knew the exact reasons behind this growth. But if I had to guess, it would be due to the record low interest rates, the record levels of government stimulus, and that record high consumer confidence. Now, this brings us to the next topic. With so many government programs all winding down in the coming weeks, how will this affect the housing market? There is without a doubt that these government programs provided a lifeboat for many struggling Australians affected by the sudden lockdowns imposed in March. And without such measures, the Australian economy and the Australian housing market will be in a very different position right now. However, based on the data released in this article by ABC News, the number of people collecting JobKeeper payments have been decreasing steadily, beating even the government's conservative estimates. The data revealed that only 1.54 million Australians collected JobKeeper payments in the December quarter, beating the government's estimates of 2.2 million. This is also a 57% decrease compared to the data collected in April to September. I personally believe this shows not only a strong recovery in the jobs market, but in the Australian economy as a whole. However, something of concern here is the high number and high percentage of people collecting JobKeeper in Victoria. With 600,000 people still on the program, it represents almost 40% of the 1.54 million people still relying on JobKeeper payments. Based on this data and the lengthy lockdowns that we have seen in Victoria over the last 12 months, I believe we should keep a close eye on the Victorian property market over the next few months, because Melbourne is still Australia's second most expensive property market, and we've had the least amount of time for our local economy to recover. So it could be argued that the Melbourne property market is still very fragile. However, the promising sign here is the downward trend of the number of people collecting JobKeeper payments, and this trend is likely to continue falling. If we look at the unemployment data provided by the Australian Bureau of Statistics, we will see a very similar downward trend, suggesting that more people are jumping back into the workforce, which in turn means less people are relying on the JobKeeper supplement, which is also due to end in the coming weeks. Before we move on and talk about the home builder scheme, There are a number of important things to note here. First and most important one is how likely the end of JobKeeper and Jobseeker is likely to influence people's ability to make mortgage repayments. Though I can't say for sure, my personal opinion is that the effect will be minimal due to the fact that the payments have been slowly decreasing, which should have made people less reliant on it, along with the fact that our economy and our jobs markets have been recovering very strongly in the last quarter. And I believe this trend is likely to continue when the latest data is released. Along with the sad fact that the people who were most affected by the lockdowns and the people who are most likely to be on JobKeeper, this population represents a very small percentage of homeowners. Despite what most people think, I believe the end of JobKeeper is unlikely to have a massive effect on the Australian housing market. However, what has definitely contributed to our real estate boom is the home builder scheme, which according to this article by the Australian Financial Review, attracted more than 63,000 applicants. This is a huge number, and prior to the scheme, first home buyers only made up 15 to 16% of loan applications. They now make up more than 25%. That's an increase of 47%. With this very generous scheme winding down, it could suggest that the level of first home buyer activity in the market could also drop, but to what extent and by how much is anyone's guess. Despite what most people might think, I personally don't think this is a bad thing for the Australian property market, because the property market is already growing at such unsustainable levels. I will personally be much happier with a slower and more steady growth. And second of all, there is already a huge imbalance between supply and demand. There is simply not enough properties coming onto the market to meet the growing demand. And as a result, people are offering and paying ridiculous amounts of money to get into the property market, often stretching themselves financially. We have already seen government intervention in New Zealand to cool their property market, and I believe we can also see that in Australia if our markets continue growing at our current rates. With that said, there is another factor that could slow down the growth of our property market, and that is the end of the bank repayment holidays. Based on this article by Money Magazine, there are still around 145,000 Australian mortgages on deferral at the start of February 2021. The good news is that the number represents a 61% decrease from the original 500,000 Australians who decided to put their mortgages on hold. Even though this downward trend is very promising, there are still more than 145,000 mortgages on hold, and this could lead to repayment issues and foreclosures if the banks don't provide additional support. However, as mentioned before, the Australian property market as a whole is seeing a massive shortage of supply. If we look at this graph provided by CoreLogic, we can see that both number of new listings and the number of total listings are well below average. I believe if the buyer sentiment continues to stay strong, even if these 140,000 mortgages were all foreclosed on at the same time, the market will have the ability to absorb all of these listings and rather quickly. Based on the numbers and data that we have seen for the JobKeeper scheme, the Jobseeker scheme, the home builder scheme, and the bank repayment holidays, the impact of all of these programs coming to an end at the same time is definitely going to have an effect on the housing market. However, if I had to guess, my guess would be that the effect will be very minimal and definitely not enough to trigger a major property crash. I base this opinion purely on the numbers, the market conditions, the state of our jobs market, and our economy. While most of these factors don't really concern me, there is another issue that I believe is a bigger concern than all of these factors combined, and that is the bond crisis in Australia and around the world. This is a topic that has been coming up a lot on the news lately, and it is definitely a cause for concern. A lot of people, including myself, had no idea how the bond market works and how it has potential to cause a spike in interest rates. So after some research and self-education, I've been able to identify the links between the bond market and interest rates, and I will attempt to share this with you guys. Due to how well our economy is recovering and how much money is being printed by the central banks, inflation is starting to become an issue, and investors are starting to realize that the returns they are receiving from these bonds are not even keeping up with inflation. And as a result, they are selling these bonds to put the money into more productive assets that are going to earn them a better return. When this happens on a big scale across the world, like we have seen in the last few weeks, it drives up interest costs as the value of the bonds decrease. I know this is all very confusing, So the easiest way to understand the relationship between bonds and interest rates is that bonds have an inverse relationship to interest rates. When the cost of borrowing money rises, bond prices usually fall. What we have seen is a drop in bond prices due to the recent sell-offs, meaning interest rates is likely to rise as a result. This is horrible news to the Australian property market, the Australian economy, and the global economy. As you can imagine, if the interest rates in Australia were to suddenly increase by 2, 3, 4% or more, it will cause a sharp increase in repayments. And this is going to force a lot of people to sell their homes and increase the number of foreclosures as people can no longer afford these higher repayments. In my previous videos, I have talked a lot about risk management and why we shouldn't stretch ourselves financially. And this is the exact reason why I think it is important to exercise caution when investing in the property market. I personally believe this is the biggest risk to the Australian property market going forward, a sudden and sharp increase in interest rates. However, we must not underestimate the ability of our central bank and government to manipulate the different markets of Australia, including the bond market. The entire Australian economy and the many different markets of Australia are all dependent on the low interest rates that we are currently seeing. And I believe the central government and banks will do everything they can to keep these interest rates low. According to this statement by the Reserve Bank of Australia, the Reserve Bank will commit to a further $100 billion of stimulus, which involves bond purchases of almost $5 billion a week. To understand why the Australian government and the Reserve Bank of Australia is so obsessed with the property market and keeping it going, we need to first understand what the Australian property market means to the Australian economy. According to this article published by the University of Melbourne, around 50% of average Australian household assets are tied up in real estate. And according to the latest GDP data and the composition of the Australian economy, finance makes up 9% and construction makes up 8% of the total output of our entire economy. This means around 17% of the Australian economy is dependent on the real estate market. And this doesn't even include all the supporting industries that keep these sectors operating smoothly. With so much wealth tied up in real estate and so much of our nation's GDP dependent on the property market, we can start to see why the Australian government and the central bank need to do everything they can to keep this market going. And this is exactly what we have seen in the last 12 months. The governments and the Reserve Bank of Australia have done everything they can to keep the property market going. If you think the end of the JobKeeper scheme and the Home Builder scheme is the end of government support, then you couldn't be more wrong. With responsible lending practices to be axed next month, and the JobMaker scheme along with a variety of other government programs soon to start, I believe we are simply moving into a new period of government stimulus and support. So what do you guys think? Is a real estate crash on the way? Or is the government going to save the day? I would love to hear your opinions and chat with you guys. So please leave your comments in the comment section below. Alright guys, I know this has been a long video and I want to thank you guys for watching till the very end. It is time for my honest opinion about what's going to happen to the Australian property market. Again, this is not financial advice, it is only my personal opinion. I believe a correction is likely in the future, but it is almost impossible to accurately predict when this will happen. With the responsible lending practices soon to be axed, so much buyer demand, and so much government stimulus, I believe we are going to see some more growth in the property market in the coming years. However, this is also some very dangerous times right now, and we should never overstretch ourselves financially in such a crazy market. But this is exactly what I'm seeing right now. Too many people are paying crazy prices in a crazy market, and in the process of it, they are stretching themselves financially and exposing themselves. We need to understand that interest rates will increase in the long term, and that means higher repayments. And we need to be confident that we can make these repayments when the rates do rise. With that said, I am not a financial advisor and this is not financial advice. I will always encourage you to do your own research and due diligence. And this brings us to the end of the video. I want to thank you guys for watching till the very end and hope you guys got some value out of it. If you did, support my channel by hitting the likes button and subscribing to the channel for more content just like this. And I'll see all of you guys in the next video.